Hello, this video tutorial will cover basic error analysis in the context of concepts covered in Chapter 13. During this video, we will first go through an overview of Chapter 21 basics, specifically accounting policy changes, changes in estimates, and accounting errors. This is a concept that students hate and they have the most trouble with because no two questions are the same. Students have a habit of, in financial accounting, memorizing an approach or a method, and it requires very, very high level critical thinking to consider the impacts of an error or policy change in one year or the other. So students have a hard time with it. And what we did is decided to, rather than have it as a chapter on its own, sprinkle the concepts of accounting errors throughout the course, and I think that this is a much better way to cover it. So after we go through some of the basics very quickly, we'll basically look at demonstration problems. So we'll do Astronomy Inc. and Prism Corp. And the only way to really learn how to deal with accounting errors is to do them repeatedly. And so by introducing them at the very beginning of the course and working with them throughout, you should have a better time with them. You are encouraged to read pages 1303 to 1313 in Chapter 21 to help you familiarize yourself with policy changes, estimates, and errors. So what we're doing here is just covering the absolute basics of what you need to know. So there are three types three items that comprise policies, estimates, and errors. And the first is a change in accounting policy. And a change in accounting policy very simply is a change in the choice of specific rules, basis, or conventions or practices applied by the company. So an example that's included here is a change in let's say from weighted average cost flow formula to FIFO. And in cases of accounting policy changes, these are accounted for retrospectively or retroactively, which means that we need to make an adjustment to retained earnings to compensate for any effects on prior year income statement. We used to call that prior period adjustments, and some people still do. Now, we only make adjustments to retained earnings if we need to compensate for a prior year. We need to sometimes make adjustments to current year revenues or expenses to capture any current year impacts, assuming the books are still open. This will usually be the case. The current year is going to be still open. And then any adjustments to current year balance sheet accounts might be necessary depending on the situation. So if it's change in inventory policy, we have to make sure that the inventory balance is correct under the new proposed method. Or property, plant, and equipment, if it's a depreciation policy change, etc. The next item is a change in estimate, and changes in estimates are usually pretty easy. Examples of changes in estimates could be, here we go, here you go, change in the service life of an asset, right? So we buy a truck and we think that its service life is going to be 10 years, and it turns out that we use it a lot more than we expected, and it's taking a pounding, and so its life is now expected to be 8 years, right? So in cases of changes in accounting estimates, we account for those prospectively, right? Not retroactively, but prospectively. And basically prospective adjustments or application includes current and future years. So we would adjust the current year, right, revenues and expenses if required to capture any current year impacts, of course, again, assuming the books are still open. And then we would apply the change in estimate to future accounting or future accounting periods as normal. The last item is a correction of a prior period error, and that's what most of the items that we're going to deal with are. And basically, they are quite simple. They're omissions, right, or mistakes in the financial statements for one or more periods, right, caused by the misuse or failure of or whatever, right? It's basically somebody makes a mistake. And in cases of mistakes, or errors, those are also accounted for retrospectively or retroactively. So accounting policy changes are treated in the same manner as errors are. We would adjust retained earnings to compensate any prior period effects, or compensate for any effects in prior periods. We would adjust current year revenues and expenses to capture any current year impacts. And we would make an adjustment to the current year balance sheet accounts to correct any of those mistakes or errors. So let's begin with an example. We'll look at Astronomy Inc. And the requirement is very simple here. Indicate the effect of the error if left unrecorded, right, or if left uncorrected. What impact would it have on net income for each of the years 2017 and 2018, right? So the text here says that the company did not accrue $6,000 interest on a note payable at December 31st, 2017. That interest expense was recorded when paid early in 2018. So the problem here, let's use a highlighter, is that this $6,000, right, was not accrued at December 31st, 2017. So that means that the expense for 2017 is understated. So that's what U means. EXP is expense, U is understated, right? Because it wasn't expensed, so the expense is too low. Consequently, the net income is overstated, right? The net income is too high. If your expenses are low, the net income is too high. Then what happened is that interest was recorded when paid in 2018, so that interest expense. So this got expensed in the wrong year, right? It got expensed in 2018. So the expenses are too high or overstated in 2018. And because the expense is too high, the net income is too low. So what we have to do to fix that, first of all, this is an error, right? Very obviously an error. So it requires retroactive or retrospective application. And we can only correct in 2018. We cannot make corrections in prior years. The only way we can impact the prior year is through retained earnings in the current year. So because the $6,000 should have been expensed in 2018, we need to debit retained earnings, right, to properly reflect a debited interest expense in the previous year, and credit the current year interest expense, right, for $6,000, because this should not have been expensed in 2018. Okay, next item number 2 here. So on April 1st, 2017, $4,800 was received in advance for work to be done evenly over a 2-year period, right? Except that the entire amount was received and credited to unearned revenues, which is actually okay, but then what happened is no adjusting entries have yet been done on this account. So what we've got going on here basically is our 2017 expenses, sorry, now not expenses, our revenue is now understated, because what happened was this was for work to be done from April 1st, 2017 to March 31st, 2019. So we should have recognized a portion of revenue in 2017. So the revenue is too low, understated. And if the revenue is too low, that means the net income is too low. Well, the same is true for 2018, right? We should have recognized a full year of this unearned revenue as earned revenue in 2018. So the same effect in 2018. The revenue is understated, too low, resulting in net income being understated. So this is an error, and to correct that error, it also requires retrospective application. So what we would do is, really the easiest way to do it is to figure out first what the prior period impact is. So PY is prior year, and that's the retained earnings piece. Now, there are 9 months, right, from April to December 31st, because the company has a December 31st year end. And so what happens is $4,800 is the amount of the fee that was received in advance. So 2017 should have received 9 out of 24, right? 24 months total, 9 months. So retained earnings should be credited for $1,800 for the revenue in 2017. That is 2017. Then the current year revenue, 2018, should get a full year, 12 out of 24 months, or $2,400 for 2018. Well, between the two credits, you end up with having to balance out, and we have a net debit to unearned revenue of $4,200. And what happens is then the result is that the remaining balance in unearned revenue is going to be $600, which is the remaining 3 months, right, from January 1st to March 31st, 2019. This is a 2019 revenue to be earned. So 4,800 times 3 over 24 is $600. And if we would take our original 4,800 minus the 600 balance, that results in $4,200 being used up. So we know we did it correctly. So now item 3, accrued interest for $3,200 on a mortgage payable was not recorded at December 31st, 2016, but expensed when paid in 2017. Also, at December 31st, 2018, accrued interest for $5,000 has not been recorded. So what do we have here? Well, this 2016, this is an error, this 2016 error spills over into 2017, right? So it was expensed in 2017, which means that the expenses are overstated or too high, right, by $3,200. And so if the expenses are too high, the net income is too low or understated. Then this 2016 error then stops in 2017, okay? And the only error we have left is the 2018 error, right, where in this case the expenses are understated. We have not yet accrued this $5,000, so the expenses are understated, which means net income is overstated. So to correct it, this is an error, retrospective application, except that we do not need to correct for the 2016 error. It self-corrects to retained earnings over 2 years, so we don't need to worry about it. What happened was the 2016 expense was too low, right, which means that retained earnings was too high, but then by carrying that over into the next year, the 2017 expense is too high and the retained earnings would be too low. But over 2 years, errors always self-correct. That's something to remember. Write that down. So we only need to make a correction for the 2018 error. We're going to debit interest expense for $5,000, and we're going to credit interest payable for $5,000, and we've taken care of this problem. Right, item 4, at December 31st, 2017, the company is being sued, right, for $25,000, but legal counsel determined that the probable loss would amount to $10,000, and no entry was made at December 31st, 2017. Then along comes 2018. The company settled, right, at a cost of $7,500, which was debited to legal expense. So the problem here is that the company should have accrued a contingent liability in 2017. It should have debited a contingent liability, debited litigation loss for $10,000 and credited a contingent liability. So what happens is, because it didn't do that, the expenses are understated, too low, and therefore the net income is too high. And then what it did is it pushed the transaction into 2018 and debited legal expense when it shouldn't have. And so that means in 2018 the expenses are too high and therefore the net income is too low. It's understated, right? So to correct this, it's an error, retrospective application. We need to debit retained earnings for the $10,000 probable amount that should have been recorded properly in 2017. If this was done right, it would have been a debit to litigation loss and a credit to litigation liability, but that didn't happen, right? Now, then in 2018, because the amount should have been recorded and accrued as a contingent liability, any amount paid would have come out of that liability. So there should be no expense in 2018. So we need to credit the legal expense for $7,500. Well, the difference between the two to make this journal entry work is simply a plug of $2,500. It's a credit to litigation loss or recovery, which makes sense because if the company would have accrued a $10,000 loss in 2017, it overestimated, right? The net total loss would only have been $7,500. So by debiting the litigation loss in 2017 for $10,000 and then crediting it for $2,500 results in a net litigation expense of $7,500. Note that there's no adjustment here to any contingent liability because no contingent liability was set up or drawn against, and now that the legal suit is settled, there is no contingent liability going forward. All right, item 5 here. Company offers a 3-year warranty. And it records the warranty expenses when the actual repair costs are made using the cash basis, which is actually wrong, rather than the warranty expense approach, which we would have covered already had you been keeping up with the material. So the best estimate is that warranty repairs will amount to 3% of sales, right? And they give you a summary of sales below. So in 2017, sales are $8,000, but the repairs are $4,000. In 2018, sales are $900,000 and repairs made are $20,000. So the effect that we have here is basically that the company should have accrued a warranty liability and corresponding debit to warranty expense of 3% of the $800,000. And then in 2018 should have done 3% of $900,000. Now 3% of 800,000, if you do the math in your head, is 24,000, but they only recorded $4,000 in repairs. 3% of 900,000 is 27,000, and they only recorded 20,000. So what this means for us is that in 2017 the expenses are understated, right? They're too low, and because the warranty expense is too low, the net income is too high. The same is the case for 2018. The warranty expense is too low because the estimate exceeds the costs that were actually incurred, and therefore the net income is too high. So to fix it, again, another error with the retrospective application. In 2017, the warranty cost should have been $24,000. In 2018, the warranty expense should have been $27,000. Again, 3% multiplied by those sales numbers. So we can do this in two separate pieces. We can deal with the adjustment to 2017 or the adjustment to retained earnings to reflect the 2017 error, is that we would debit retained earnings for the $20,000 that's missing, right? Which is basically the $24,000 that should have been expensed minus the $4,000 that was expensed. And then the corresponding credit would be to warranty payable, right? Warranty liability. Then in 2018, the same approach, except that now the books are open so we can debit the expense, right? The expense should have been $27,000. The company used the cash basis, so it only expensed $20,000. So there's a missing debit to warranty expense of $7,000, and then the rest goes to warranty payable of $7,000. Now, if this was all done correctly from the beginning, the ending balance in the warranty liability account or the warranty payable account would be $27,000. And we can prove that with the T account. Look at this, warranty payable or warranty liability. If the first entry would have been a debit to warranty expense and a credit to warranty payable for the 2017 expense of $24,000. Then they would have recorded the costs incurred, so they would have debited the warranty payable and credited cash. That would have left a balance of $20,000 at the end of 2017. Then in 2018, this would be the third transaction. They would have debited warranty expense for $27,000, credited payable, and then the last transaction, number 4 here, would be to record the costs, right? So they would debit the warranty payable and credit cash. And so when all this is said and done, the balance at the end is $27,000. And you can see that based on our work, we end up with, between these two items here, look at this, the $20,000 and the $7,000 gives us a balance of $27,000 in the warranty liability, so we know we did it correctly. Item 6 now, in 2018, the company recorded warranty expense based on 2% of sales. In the past years, the expense was recorded based on 2.5% of sales. And a summary of the estimated repair costs and percentages. So, based on 2.5% and 2% for past years, it should have been 100,000 versus 80, and for 2018, 40,000 versus 32,000. So, what do you think this is? Well, if you said it was an error, unfortunately, you would be incorrect. This is a change in estimate. So what happens is, just because the amount that was 2.5% previous, or sorry, 2% previously, that it's now 2.5%, that's okay. It's a change in estimate. The company, based on its history, has determined that it should be using. Sorry, I had it backwards. That they were basing it on 2%, and now should be. No, in past years, it's based on 2.5%. So it was using 2.5% previously, and it wants to use 2% now because its history says that it's 2% is more reasonable. So what we have here is no over or understatement of warranty expense in 2017 and no overstatement in 2018. This is a change in accounting estimate, and therefore the application is prospective with no adjustment necessary in the current year, because in 2018 they have applied it properly. And that's all there is to it, and that actually ends Astronomy Inc. Okay, so now we'll move on to Prism Corp. So as an auditor of Prism, you discover that there are some items for the year ended December 31st, 2018, right? The key here is that the books of Prism Corp are still open for 2018, and you just need to prepare any correcting entries, right? So the first item is bonuses owing at the end of the year were not recorded. Instead, bonuses were recorded in the following years when paid. So in order to fix this, it's really quite simple. It's an error. We don't need to fix it, right? Because this happened in 2016, right? This is a December 31st, this first item, December 31st, 2016. The 2016 expense is too low, and that was pushed in 2017. That's too high, but it self-corrects over 2 years, so we ignore it. The retained earnings are fine, and we do not need to make any entry. For 2017, however, right, the 2017 item is pushed into 2018, so the 2018 expense is too high. So what we have to do is we have to pretend that we properly debited the expense in 2017. So we would debit retained earnings for $6,000, right? And that basically pushes it back to the previous year. And instead of debiting the bonus expense in 2018, we need to credit it, right, in order to fix it. And that problem is now taken care of. Then in 2018, they do the same thing, right? This $5,000 expense should be accrued in 2018, so the expense is too low, so we're going to, and because the books are open, this is a very easy one to fix. We're just going to debit the bonus expense for $5,000 and credit bonus payable for $5,000, and it's now we can do a combined adjustment, which is basically to put all these like items together. So we could take retained earnings, debit 6,000, right? That's what this is, retained earnings, debit 6,000. We have one credit to bonus payable for 5,000, so that's the bonus payable 5,000. And then the bonus expense is 1,000, and that's the difference between the $6,000 credit here and the $5,000 debit over here gives you a net credit of 1,000 to bonus expense, and this is taken care of. Right. Item 2 here is that the company did not accrue $2,000 interest on a note payable at December 31st, 2017, and that interest expense was recorded when paid in early 2018. So what this means is that, this one's easy actually, change my color pen here, is that this 2017 expense was pushed into 2018. So the 2018 expense is too high and retained earnings are too low. So in order to fix it, it's a very simple adjustment. We're going to debit retained earnings for $2,000 to put this back into a prior year. And because the $2,000 does not belong in 2018, we're going to credit the interest expense for $2,000, and that takes care of that error. Next item, at December 31st, 2017, the company is being sued for $10,000. The lawyer indicates that a reasonable probable loss would be $25,000 and no journal entry was made in 2017. So this is similar to the one we saw with astronomy. In this case, what we're going to have to do is we use the probable amount that should have been recorded in 2017. So to fix the prior period item, we would debit retained earnings for $25,000 and credit a contingent liability for $25,000, right? Then, then in 2018, the company settled a lawsuit at a cost of $30,000 paid in 2018 as a legal expense. So then what this means here is that this $25,000 needs to be removed from the contingent liability, right, if it was set up properly. And our legal expense in 2018 is actually $25,000 too high because this should have been expensed in the previous year. So we could do this in two separate adjustments, or we could do it in one single combined adjustment where we credit the retained earnings, debit the retained earnings for $25,000 to represent the 2017 correction. Then we would credit legal expense for $25,000 from over here, right? And that leaves a net 2018 legal expense of $5,000. Remember that the debited legal expense for $30,000, and the reason why the net legal expense in 2018 is $5,000 is because basically, if they would have set this up in 2017, they were too short, right? They thought it was going to be $25,000, it was actually $30,000, so the expense would have been short in 2017. They need to make up the other $5,000 in 2018. The solution uses the term legal expense here. I prefer like litigation loss, so that it's very clear to the user, the reader of the financial statements, that it's not just a regular legal expense, that it relates to a some kind of litigation. But the point is that there is no adjustment in this combined entry to the contingent liability, because if we set up the contingent liability first to correct the prior year and then get rid of it, because the lawsuit has been settled, right? So on the left side here, we have a credit to the contingent liability of $25,000, and on the right side, we have a debit to the contingent liability of $25,000. So it cancels each other out. So all you have to worry about is the retained earnings and the current year piece, and that takes care of this. All right, for our last item here, in 2017, company started offering a 2-year warranty. The warranty expense for 2017 and 18 was recorded using the cash basis when the repairs were made. So just like with the astronomy example, instead of using the proper warranty expense approach. The best estimate is that the warranty costs are 2% of sales, and we are provided with a summary of sales and actual repair costs for the 2 years. So in 2017, the sales were $2 million and the repair costs were $10,000. So what happens is we are missing something here, right? Because if the company would have followed proper procedure for warranties, they would have debited warranty expense for 2% of $2 million, which is $40,000 in 2017. And so because they only expense $10,000, they're missing a $30,000 liability, and also the expense is too low. So because it relates to 2017 and the books are open in 2018, we have to debit retained earnings for $30,000 to correct the prior period error and set up the warranty liability for $30,000. Then in 2018, sales are 2.5 million and the actual costs incurred are only 30,000. So the amount that should be recorded in 2018 as an expense is 50,000, but they only expense 30,000, so there's a difference of 20,000. And that means that the expense is also too low in 2018 for the amount of $20,000, so they have to adjust that expense. So debit warranty expense for 20,000 and credit warranty liability for 20,000, and that takes care of this error, and that ends the Prism Corp problem. So this concludes the video tutorial on Chapter 13 Error Analysis. I hope you found it useful. Of course, if you have any problems understanding of this, please feel free to let me know, and I'll help you in any way I can.